Hello, friends, and welcome to Advanced Financial Modeling, Stock Research, and Valuation course. We have reached the most significant part of this course where we learn to do discounted cash flow modeling. This is our Chapter 4, Assignment 4. Namaskar, hello, and welcome, friends, to this Advanced Financial Modeling, Stock Research, and Valuation course. This course is for investors and finance students who are looking to understand how professionals value stocks. The course comes with a dual certification program. One is for the course completion and one is for internship completion. So, for those who are interested in enrolling to the course certification program, the details are given in the description and in the end of the video. You can check that out. Meanwhile, the entire course material is available freely on YouTube like this video, so you can learn it freely anywhere, anytime. Students who are pursuing courses like MBA Finance, CFA, CA, CPA, MCOM, BCom have all taken this course and benefited from it. If you are an investor or if you are a finance student, this course is for you if you are looking to understand how professionals value the stocks. What is the eligibility for this course? The good news is we have structured the program assuming that the viewer is a beginner. So, from a beginning stage, if you do all the assignments and all the chapters one by one without skipping them and applying them hands on, then by the end of this course, you are assured to have an advanced level knowledge of how stock valuation is being done. And regarding the course content, let us discuss that now. First, we come to the stock filtration. Any stock exchange, if you visit, you will find that there are thousands of stocks. For example, Nasdaq has more than 3,000 stocks. NSE and BSE together have around 8,000 stocks. So to begin with, we need to find out a way where we can filter out all these thousands of stocks and reduce the number to a manageable list which we can do deep analysis on. In the first assignment and first chapter, we show you an efficient way, an intelligent way of segregating the stocks and filtering them out. In the second chapter and second assignment, we try to understand how to interpret the cash flow statement, the balance sheet, and the income statement and bring them together to do ratio analysis. Ratio analysis brings us to chapter 3 and assignment 3. In chapter 4, assignment 4, we are going to study together in a detailed way how to do discounted cash flow valuation. Apart from that, we will also learn how to do dividend discount model valuation and residual income valuation. After learning how to do discounted cash flow valuation, we get into detailed reading of an annual report. We take a company which is listed in the stock markets and we read the annual report together along with you. After learning discounted cash flow modeling and valuation, we move into valuation of financial institutions, that is, banks, NBFCs, etc. The valuation of banks and financial institutions is a bit different than the typical manufacturing company or even an IT company. So we understand how to mathematically value a bank or a financial institution in this assignment. This is assignment 6, chapter 6. Assignment 7, chapter 7 is about understanding the monetary system and the currencies. We delve deep into the history of monetary system, the evolution of currencies, and the impact of central banking policies and the state's financial and monetary policies on the economy, especially during recession times. In the last chapter, that is assignment 8, chapter 8, we move into understanding the specific analytical parameters for specific industries and specific companies. For example, a mining company is analyzed differently than a retail company. A retail company is analyzed differently compared to an IT company. An IT company is analyzed differently compared to a banking company. So specifically, each of these industries have some specific parameters. We understand what those parameters are and how to understand them in this last assignment. And once all these things are over, the main goal is for you to become capable of valuing stocks like professionals do and creating reports like professionals do. So without further ado, let's get started. This is the third segment of Assignment 4, Chapter 4 of Advanced Financial Modeling, Stock Research and Valuation course and Internship. Here we learn how to do dividend discount modeling or dividend discount valuation. You'll be really happy to know that the content of this segment is directly taken from CFA Level 2 curriculum. Let's start learning. Let's get started.
Hello friends, how are you doing? Today we are going to introduce a new chapter which is part of the equity valuation only. It is called Valuation through Dividend Discount Model. Now what do we mean by valuation through dividend discount model? It is basically using dividends future flow of dividends to calculate the present value of the company. So thereby goes the definition. Value of a company is the present value of future dividends earned. Now, is this definition complete? Certain questions arise. What if the company is retaining earnings for growth? Are we including it in the dividends earned calculation here? The answer is yes. Why yes? Because the argument goes like this. If the retained earnings are at a nice level, then the future dividends will reflect the growth earned from those retained earnings. And therefore, if you value the company based on future growth rate of dividends, that will itself get included automatically. What about control? Control means if we have the ability to take decisions alongside the management or play the management itself and take decisions in the operations of the company. The answer is dividend discount model takes a posture where there is non-controlling interest. That is, it is like a retail investor or an investor who doesn't have that much stake in the company where he or she can influence the decision makings in the company. So it is a non-controlling stake or non-controlling position. So therefore, the only tangible and immediate way to calculate the valuation of the company for this kind of an investor is what is the dividend earned from that company. The growth and the decisions needed for them are not in their control. So the only parameter they use to value a company is dividends. So we will write the answers here. What about retained earnings? Yes, dividends do reflect the retained earnings in the long term. Dividends do reflect the retained earnings in the long term. Reflect the growth due to retained earnings in the long term. And what about control? The answer is, generally speaking, investors have a non-controlling interest. Investors have a non-controlling interest, unlike the promoters. Therefore, they have to rely on dividends. Therefore, they rely on dividends. Yes, dividends do reflect the growth. If the retained earnings makes a company grow, then the dividends will also grow and the valuation will reflect that. Second is, retained earnings investors generally do not have a controlling interest, and therefore the second factor is, what about control? Generally investors have a non-controlling interest, therefore all this synergy and control and decision making and real options, all these things do not apply. Therefore they rely on dividend and dividend growth rate to value the company. Now, the most appropriate situations to use the DDM model or dividend discount model are as follows. We have to assume a few things. Dividend payout has to be stable. Dividend payouts have to be stable and correlated to the profits and correlated to net income, which means there has to be a steady kind of a dividend payout ratio, like 75% or 50% payout ratio. Second is, the position is assumed to be preferably non-controlling. Position of investor is non-controlling. Non-controlling. The third and the most obvious point is the company has to pay dividends. Company has to pay dividends. Like we said, the payout ratio has to be measurable and preferably substantial so that there is enough record to analyze. Now friends, to value a company, there are majorly three ways of valuation that is being used. One is the dividend discount model, which we will be discussing in this chapter. The second is free cash flow model, free cash flow to equity or free cash flow to the firm. Right? This is free cash flow to the firm, free cash flow to the equity. This is one way. Another way is residual income. These are the three major ways to value a company. Now each of them have certain situations where they are most preferable to use. Now we will just go through an overview of when DDM is the most appropriate process to use, when free cash flow discounting is the most appropriate process to use, and when residual income is the most appropriate process to use. We will go through them one by one. For DDM, we have already gone through the situations, that is, the payout ratio has to be there, a stable payout ratio, preferably a substantial payout ratio has to be there, that is, the company has to be paying dividends, and the position of the investor is a non-controlling position, that is, it cannot take decisions in terms of managerial levels. Okay. Now there are certain other situations where a free cash flow model is more preferable to use. What are they? Now when should we prefer free cash flow discounting valuation model over dividend discount model? Firstly, when dividends do not bear a perfect relation with the profits. Dividends are highly varying and R, that is correlation with respect to profit, is very low. Second is, or it might be a case where the company is not paying dividends at all. So you have no data of dividends to measure the valuation from dividends. No dividends. Third can be capital structure changes. Capital structure may change over the time in a drastic way. That is one of the reasons when free cash flow method is better to use. And along with this, when free cash flow has nice correlation with the net income, right? Free cash flow, if it has a very predictable relation with the net income, then it becomes easier to use this kind of a model to value the company. And these four reasons together, if are present in a company, then DDM becomes a less preferable option. Free cash flow valuation becomes a more preferable option. Now we already discussed when is a dividend discount model appropriate to use and when is a free cash flow discounting model appropriate to use. Now there are situations where both these models do not work very well. For example, let's say the company is not paying any dividends, right? The company is not paying any dividends whatsoever. And not only that, it's in a certain phase of development, most probably an early phase of development, where FCFF is negative. FCFF or FCFE, whichever you are using for valuation, is negative. Now in such a scenario, even using FCFF model becomes invalid. It does not give a proper answer. In this kind of a scenario, we can use something called a residual income model. So we will, this is basically a separate chapter, but here, because we are discussing these things on a comparative basis, we'll take an overview of it. What is residual income? Let's understand that. Let's say you have invested in a company named ABC and your required rate of return is 11%. This is your required rate of return. Required rate of return means what? You have foregone the second best opportunity to choose this because you feel this company has a probability of giving you better return than 11%. So you had an investment opportunity, say DEF, which was giving you 11%. Okay, but you did not choose it. You chose this one because this one has an opportunity, this one you feel has an opportunity of giving you better returns than 11%. So let's see, you invested, say you invested $1,000 here and you earned $140 on the first period. So this translates to 14%. So what is the difference between your required return, that is the return you have foregone to invest in ABC? You have foregone an investment of 11% to invest in ABC, and ABC has given you 14% return. So your extra return is 14% minus 11%. So this is 3%. This 3% is basically your residual income. Residual income is defined as excess return over the required rate, excess return over required rate of return. This is the basic definition of residual income. And when it is appropriate? When, let's say, the free cash flow model is also failing because there are no free cash flows and there are no dividends. This is an ideal situation to use this model. Friends, now we will look at the DDM model being applied to a holding period of 1 year. How does that work? Let's say you are investing in a company where you expect a dividend D1 to be given to you over a period of 1 year, and at the end of the period the price will be P1 for that company, right? So your valuation becomes D1 by 1 plus R to the power 1 plus P1 by 1 plus R to the power 1. This becomes your V0, that is value at time 0 or intrinsic value at time 0 when you are using DDM model. D1 is what? D1 is basically the dividend you are expecting in the period of this 1 year holding period. P1 is at t is equal to 1. This is going to be the price at which you are going to sell this investment, right? So this is P1. This becomes your value at the current t is equal to 0, right? This is your formula for 1 year holding period TDM model. Similarly, if you are going to hold it for multiple years, then it becomes in a different way. Let's say you are going to hold it for 5 years, or let's say you are going to hold it for 3 years. So at t is equal to 3, the price will become P3. At t is equal to 3, you are going to earn a dividend of D3. At time is equal to 2, let's say it is D2. At time is equal to 1, let's say it is D1. Now your value at the present moment becomes D1 by 1 plus R to the power 1 plus D2 by 1 plus R to the power 2 plus D3 by 1 plus R to the power 3 plus P3 by 1 plus r to the power 3. This r obviously here also in the 1 year holding period also, and here also r is the required rate of return. So this is basically a summation, right? So we write it in a different expression also. Here we write it like this: summation of di by 1 plus r to the power I for the entire holding period. I is equal to 1 plus 1 till n plus Pn by 1 plus r to the power n being the final holding period, right? So this is the expression for a holding period of n periods, where you are getting D1, D2, D3, D4 till Dn amount of dividends, and you are selling the investment at price Pn at period n, and R is the required rate of return. So this is how you do it. Let's take an example here of a three-year holding period and a certain amount of dividend. Okay, so let's say 1, 2, 3. At year 1, you will be getting a dividend of $8. At year 2, you will be getting a dividend of $11. At year 3, you will be getting a dividend of $15, and your selling price will be, let's say, 108. Your required return, let's say, is 8%. So this becomes 1.08 to the power 1, because it is 1 plus r to the power 1 plus 1.08 to the power 2. So r is equal to 8%, let's say here, plus 15 by 1.08 to the power 3 plus 108 by 1.08 to the power 3. This is going to be your value at t is equal to 0, right? So let us calculate it quickly. This is 7.4. The second expression is 1.08 square 9.43 plus 15 divided by 1.08 to the power 3, which is 11.9 or 91 approximately. Same 108 divided by 1.03 to the power 1.08 to the power 3. So this is 85.73. Now if you sum it up, it comes to plus 11.91 plus 9.43 plus 7.4. This comes to 114.47. So this is our V0 in this simple example that we have done. Now we have looked at multi-year holding period and a single year holding period. Now we are going to look at an infinite holding period. So for example, we are going to hold something for perpetuity, and the growth rate of the dividends is going to be perpetual. Growth rate of dividends is going to be constant and perpetual. So if you draw a graph, let's say you are going to draw a graph where here there is the growth rate Here there is time, number of periods. The line goes like this, it's a straight line because it's a constant. I'm not drawing it properly, but it's basically this line and this line are parallel. It's going to be constant till perpetuity, right? And if you draw a graph with respect to the number of periods of the dividend, it will look like this. If we draw the graph of dividends with time for a perpetuity constant growth rate, it will simply look like this. It will be a straight line which is slanting, and the slope is basically the growth rate. So this is the dividend and this is the time. We are writing time in a discrete manner here so that we can understand it better. You can also write it T. Now what is the formula for this? So for an infinite series like this, we do not keep on writing like this, like to the power 1, to the power 2, to the power 3, we do not do that. What we do is basically V0 is equal to D0, that is dividend at time 0, into 1 plus the growth rate, which is the perpetual growth rate, divided by R minus G, that is R is the required rate and G is again the perpetual growth rate. This is the formula that we use for a perpetuity, that is a perpetual growth rate kind of format. And this is also a single stage, guys. You can see there is only one stage where the growth is perpetual till infinity, that is. Let's take an example. Let's say at t is equal to 1, the dividend is $5. The growth rate is 8%. This is a perpetual growth rate and the required rate is 12%. Right, guys? So what is the V0 or value here? So this will be 5 into 1.08 by 0.12 minus 0.08, right? No, the answer is no. Why? Because here I mentioned at t is equal to 1. At t is equal to 1. Listen very carefully. At t is equal to 1, the dividend is 5, not at t is equal to 0. Here what we have written is d0, that is dividend at d is equal to 0. And by multiplying it with 1 plus g, we are actually trying to get the d1. So this is the dividend at the period 1. And here we have directly mentioned what is the dividend at period 1. So here this 1.08 is irrelevant, not required. So we will erase it. The only thing we need to write here is 5. So the answer is 5 divided by 0.04. This is 125. Now, if instead of t is equal to 1, we had written t is equal to 0, here we had say written, let's take another example here. Let's say at t is equal to 0, the dividend d0 is $10. The growth rate is for perpetuity 10% and the required rate is 15%. Let's say this is our problem at hand. Now what should we do? Here what we should do is exactly what is written in the formula. D0 into 1 plus g divided by r minus g, which is equal to 10 into 1.10 divided by 0.15 minus 0.10. It's going to be a simple calculation. Let's do it. 10 into 1.1 divided by 0.05. This is 220. This is our answer. So in exams this nuance can be there. It's a very simple nuance if you pay attention to it, but it may happen that you just remember the formula and forgot about this t is equal to 1 and t is equal to 0 business, and you multiply the t dividend at t1 by the growth rate, and the answer will be wrong. So just take care of that. Friends, what if there was no growth? That is, for perpetuity you are getting a same dividend. How to calculate that? V0 is equal to D0. We already know the formula, right? D0 into 1 plus G, R minus G. Here the problem is G is equal to 0. That is, there is no growth. We are getting a constant dividend perpetually. So dividend is not D0. D0 is equal to D1 is equal to D2 is equal to D3 is equal to D infinity. So D0 is equal to D1 is equal to D2 is equal to constant. So in this case, let's say the dividend is D. So here the V0 becomes D into 1 plus 0 divided by R minus 0, or simply this expression becomes V is equal to D by R. V is equal to D by R. This is the expression for a constant dividend till perpetuity. Now let's say instead of growing, the dividend is constantly declining. That is, you have a negative growth rate. Let's say your initial dividend was 100 and the growth rate is minus 10%. So you will be earning, let's say at t is equal to 0, you will be earning 100. At t is equal to 1, you will be earning 100 minus 10% of 100, which is 10. So you will be earning 90. This is at t is equal to 1. At t is equal to 1, you will be earning 90. At t is equal to 2, you will be earning 90 minus 10% of 90, which is 9. That is, you will be earning 81. Like this it will go on. So here the formula will be V0 is equal to 100 1 plus minus 0.10 by, let's say the required rate is 15%. So 0.15 plus minus, sorry, so 0.15 let's say the required rate is 15%. So this is 0.15 minus 0.10. This expression becomes 100 into 0.90 divided by 0.15 plus 0.10. This is equal to 90 by 0.25. The answer comes to 360. This is our V0 in case of a negative growth rate. In case it was positive, what would have been the value, guys? Let's calculate it also. V0 is equal to, if plus 10%, then this would have become 100 into 1.10 by 0.15 minus 0.10. This value would be 110 divided by 0.05. Therefore, V0 would have been, this is V0 minus, this is V0 plus 10%, right? So this is equal to 110 divided by 0.05, 2200. So you can see the drastic difference in valuation. This is plus 10%, this is minus 10%. Just because the growth rate is negative, the value has become drastically less. Just we can see this through this example, right? Friends, now we will look at two cases of two-stage dividend discount models. In one, the dividend has a constant growth rate in the short term, then it falls to some long-term rate or changes to some long-term rate, and then again it is perpetual. In the second option, we have a declining growth rate in the early stages and then a perpetual long-term growth rate. So if you plot the growth rates like this, the two cases, case 1, the growth rate in the early stage, the growth rate is, let's say, some higher growth rate, earlier growth rate, which is GS. This is short term growth rate. Then the rate directly falls, drastically falls to a long term growth rate, which then becomes perpetual. And this rate you can call the long term or the perpetual growth rate, or GL. In the second case, here also there is a short term growth rate which is high, but the difference is it is smoothly declining like this. It is not like a drastic decline. From GS, it gradually declines over a number of periods to GL. And after it reaches GL, that is the long term growth rate, it becomes a perpetual growth rate, right? Here we use the normal present value model. Here, instead of using the normal present value kind of calculations, we can also do it by a different method called the H model. We will learn about this H model in a very short while. Let's see how to do that. Let's take the case 1 first. So here, let's say the short term growth rate is 15%. The long term growth rate is 8%. The required rate is, let's say, 12%. And the initial dividend, that is D0, is equal to $5. And this short term growth rate goes for 5 periods. Okay? This is our example. Let's see how this plays out. So 0, 1, 2, 3, 4, 5. This is the GS period, and from there on it's a perpetual growth rate. Let's see how this plays out. So at t is equal to 0, the dividend is $5. At t is equal to 1, it is 5 into 1.15. So this is 5.75 into again 1.15. This is 6.61. into 1.15, this is 7.6, into 1.15, 8.75, 10.06. Now from here we transition into the GL. Till now it was GS, which is 15%. Here it is GL, and the GL is 8%. So this is equal to 11.4. Now let's calculate the present value. We have calculated the values that are there at t is equal to 1, t is equal to 2, t is equal to 3, t is equal to 4, t is equal to 5, t is equal to 6, etc., etc. Now from here we have to calculate the present value. How do we do that? 5.75 divided by 1.12 to the power 1 plus 6.61 divided by 1.12 to the power 2 plus 7.6 divided by 1.12 to the power 3 plus 8.75 divided by 1.12 to the power 4 plus 10.6 divided by 1.12 to the power 5 plus, here comes the perpetual portion, because this is the perpetual portion, right? Now let's say this is D5. If we have multiplied this with one time with GL, that means we have got D6, right? So 11.4 divided by 0.12 minus 0.08. We do not need to multiply this by 1 plus GL, because we have already multiplied it and we are going to get the value which is at t is equal to 5 if we derive this value, right? So this entire value has to be again divided by 1.12 to the power 5 to get the value at t is equal to 0, because if we calculate this we will be getting t is equal to 5 valuation. If we divide this by 1.12 to the power 5, we get the value at t is equal to 0. The value of this perpetual portion at t is equal to 0, we get it if we do this entire calculation. 5.13 plus 6.61 divided by 1.12 square, 5.27 plus 7.6 divided by 1.12 cube, 5.41, 8.75 divided by 1.12 to the power 4, 5.56 plus 10.6 divided by 1.12 to the power 5, 6.01 plus the perpetual term, which is 11.4 divided by 0.04 divided by 1.12 to the power 5. This is 161.717. We can just add all of this up to get the V0. Finally, V0 is, sorry, this is 161, guys. 161.717. So we add these values up to get V0. 161.717 plus 6.01 plus 5.56 plus 5.41 plus 5.27 plus 5.56 0.13. This gives 189.1 approximately. This is our answer. So in this two stage, you found that there was a constant rate GS which was 15%, and there was a perpetual rate of 8%. The required rate was 12%. The short term growth rate went on at a constant value for the first 5 periods. Then it drastically fell to a rate of 8%. From there on, it was perpetual. We just found out a two-stage valuation for this kind of a situation. Friends, now we will pay our attention to the case 2, this one. Friends, now we will pay our attention to case 2, that is this one. And we will also look at how to implement the H model, right? So, let's take the case 2. Initial rate was, let's say, 15%. This rate declined smoothly over a certain period to, let's say, GL. Let's say over a period of 15 years or 20 years, it declined to GL, and GL is 8%. The required rate again is 12%. The initial dividend D0 is $5. We will try to calculate, according to the H model, what is the valuation. Okay. So here the expression is given by, phi0 is equal to, the perpetual portion is separate, R minus GL plus D0 into H. We will look at what is H. GS minus GL divided by R minus GL. This H is basically, so let's say this rate from GS to GL took 20 years to complete. GS down to GL. This happened over a period of 20 years. H is basically half of that. It is the half-life of the higher growth rate. So here H is equal to 10. Now we will calculate the formula, guys. Calculate the value from the formula. 5 into 1.08 divided by 0.04, because it is 0.12 minus 0.8, plus again 5 into 10 into GS minus GL, which is 0.15 minus 0.08, that is 0.07 by again 0.04, right? So this value, let us quickly calculate. $135 plus $87.5. Therefore, the V0 is 222.5. In a scenario where the rate is declining smoothly over a period of 20 years from 15% to 8% with a required rate of 12% and an initial dividend of 5%, we use the H model. The H model, and this is the expression for the H model, right? By using this, we calculate the two-stage valuation in case of a smoothly declining growth rate, and the value comes to V0 is equal to 222.5. Friends, now we will look at a 3-stage dividend discount model, and particularly we'll look at a case where the second stage is smoothly declining. Okay, so let's say from time 0 to 5 the growth rate G1 is equal to 20%. Okay, from 5 to 20 or 5 to 21, say 5 to 20, this growth rate begins from 20 and ends at G3, which is equal to 10%. So from t is equal to 5, it remains at 20. At t is equal to 21, it reaches, at t is equal to 21, it reaches 10%. 20 till perpetuity, it is 10%. Apart from that, let us assume that dividend at time 0 is $10 and the required rate of return is 12%. Okay. Now what we need to do is find out the valuation. Let's do that. To make the thing a little easier, let us draw a chart. Here it is the time, here it is the growth rate. Let's look at how the growth rate evolves. So initially the growth rate is like this, 20%, right? Then at t is equal to 5, this is at 5. Then suddenly from 5 till 20, here is 20 or 21 rather, the growth rate smoothly declines to 10%. And from there on in, it remains at 10%. It remains at 10%, right? So this is the G3. This is G2. And we already know that the initial phase is G1. Okay. Now let us calculate the values. Just one point to be careful, guys. At t is equal to 21, the rate reaches 10%. That is, here it is t is equal to 21, not 20. Okay. So what we can do is, till here we can apply the normal calculations of present values, and from here we can apply the H model. Till here it is present value model, from here it can be the H model. So let us look at the first stage, stage 1. V0 stage 1 is given by $10 into 1.2 divided by 1.12 to the power 1 plus 10 into 1.2 square divided by 1.12 to the power 2 plus dot 10 into 1.2 to the power 5 by 1.12 to the power 5. Let's quickly calculate the value for this, guys. 10.71 plus 11.48 plus 10 into 1.2 cube divided by 1.12 cube is equal to 12.3 plus 10 1.2 to the power 4 into 10 divided by 1.12 to the power 4, 13.18 plus 1.2 to the power 5 into 10 divided by 1.12 to the power 5 is equal to 14.12. We add these up, plus 13.18 plus 12.3 plus 11.48 plus 10.71. The total value for this stage 1 is 61.79. So value till stage 1, the present value till stage 1 stands at 61.79. Let us now calculate what is the value at stage 2. Stage 2. Stage 2 and 3 actually we will be calculating together, because this we will be using an H model for this, right? Because there is a smooth decline. H is equal to 21 minus 5 by 2 is equal to 16 by 2 is equal to 8, right? Because from t is equal to 5 till t is equal to 21 there is a decline. From t is equal to 21 there is a perpetual rate, right? So V0 stage 2 and 3 is equal to D5. Here the initial dividend is D5 into 1 plus GL by R minus GL plus T5 into H into GS minus GL, that is, here GL means G3 and GS means G2. R minus GL. So let us see what is G3, G2 and G3. G3 is 10%, G2 is 20%. And what is D5, guys? 1.2 to the power 5 into 10, 24.88. 24.88 into 1.1 by, it is 0.02 because GL is 1.1 plus again 0.12 minus 0.10, here it is 0.02 D5 is 24.88. H, as we calculated, is 8. This is 20% minus 10%, which is equal to 0.10. So the value will be stage 2 and 3. I am writing in a concise form here. 24.88 into 1.1 divided by 0.02 is 1368.4 plus 24.88 into 8 into 0.1 divided by 0.02 is equal to 995.2. This value will come to 2363.6. And if you add stage 1 and stage 2 and 3 together, then the value comes to V123 is equal to 2363.6 plus 61.79 plus 61.79. This is equal to 2425.4. 2425.39 approximately. This is our answer. So this is a 3-stage model, with the middle stage being a declining stage, smoothly declining stage. So this is how you calculate this. Friends, now we will derive a few expressions of the Gordon growth model from the primary expression itself. So what we knew is V0 is equal to D0 into 1 plus G divided by R minus G. This was the single stage DDM or the Gordon growth model, right? Now let's say the price reflects the correct value. So this expression we can rewrite as P0 is equal to D0 1 plus G R minus G. Now if we divide P0 by E0, this becomes D0 into 1 plus G by E0 into R minus G. This can be in turn rewritten as D0 by E0 1 plus G by R minus G. Now D0 by E0, this you can write as 1 minus B, right? Here B is the retention ratio. B is equal to retention ratio. How did we arrive at 1 minus B from D0 by E0? D0 by E0 is equal to, so D0 by E0 we can write as 1 minus, within brackets, 1 minus D0 by E0, right? This we can write as 1 minus E0 minus T0 by E0, right? This is equal to 1 minus retained earnings at time 0 by E0. This is nothing but the retention ratio, which we are denoting as B. Right? This is nothing but the retention ratio. So this entire expression becomes d0 by E0 is equal to 1 minus retention ratio or 1 minus P, and we put it here. We use this formula straight away here. So this becomes 1 minus P into 1 plus G by R minus G. So one of the expressions of Gordon growth model in terms of current PE this is current PE because we are using the last reported earnings, right? Last reported dividends by last reported earnings is the retention ratio here. So this is equal to 1 minus P into 1 plus G by R minus G. This is one of the expressions in terms of E0. Okay. Now let us say we try to derive another way of expressing the same thing, just a little change. Again we write P0. This is the second way of expression. Number 1 will be this, and number 2 will be this. P0 is equal to D1 by R minus G, because we already know that D1 is equal to D0 into 1 plus G, right? So this we can divide both sides by E1 D1 by E1 by R minus G, right? If you simply have to translate this, this becomes 1 minus P by R minus G. This is the simple expression. So in terms of forward PE, if we have to translate the Gordon growth model, the expression becomes P0 by E1, that is the forward earnings, is equal to 1 minus the retention ratio divided by required rate minus the growth rate. Let's take a few examples of this. Let's say the forward earnings of a company is $115 and current earnings is $96. We have to find out what is the forward looking PE. The price projected 1 year ahead is, let's say, 2000, projected 1 year from now, $2,000. Okay. So forward earnings is $115, current earnings is $96, the price projected 1 year from now is $2,000, current price is, let's say, $1,800. So we have to find out what is the forward looking PE, right? So what is the expression for forward looking PE, guys? Should we use this value or should we use this value? Please ask yourself the question. The forward looking PE ratio expression was P0 by E1, if you remember. It was not P1 by E1, it was P0, that is current price, by the forward looking earnings. So this is the forward looking PE ratio. This is equal to 1 minus P by R minus G. This was the expression. So the forward looking PE is, do you need these informations to find it out? No, right? Because you already have E1, you already have P0. So P0 by E1 is equal to 1800 by 115. This is equal to 1800 by 115 is equal to 15.65. Now let's say we have another problem, just an extension of this one only. Find the required rate of return, find R, given retention ratio is 50% and growth rate is 7%. Would you be able to find it, guys? Let's see. So P0 by E1 is equal to 1 minus P by R minus G, right? So here, from here we can easily write R into P0 by E1 minus G into P0 by E1 is equal to 1 minus P. From here we can easily imply R is equal to E1 by P0, or the inverse of forward looking PE, into 1 minus P plus G. We just inverted it. We put G and into P0 by E1 this side and divided the entire expression by P0 by E1, which was attached to R. This is the expression that we get. We can easily put the values here, guys, and get the answer. So R is equal to 1 by 15.65, this is the inverse of the forward looking PE, right, into 0.5, which is the retention ratio, plus 0.07. Let's find out the value. This is equal to 0.10194, or R is approximately equal to 10.19%. This is our answer. Friends, in the previous example, we strive to find out the required rate of return from the Gordon growth model. Now, we will try to find the required rate of return from the H model. So for doing this, we again assume that the price reflects the correct value. Therefore, the half or the H model expression becomes P0 is equal to D0 into 1 plus GL by R minus GL, that is the required return minus the long term growth rate, plus D0 into H into short term growth rate minus long term growth rate, or short term initial growth rate which declines to the long term growth rate, divided by R minus GL, right? We do a little bit of shifting. R minus GL is equal to D0 plus D0 into GL plus T0 H into GS minus D0 H into GL. P0 into R is equal to D0 1 plus CL plus T0H GS minus GL plus P0 into GL. The expression which was on the left side, we brought it on the right side. Now we divide both sides by P0 to get the R. R is equal to D0 by P0 into 1 plus GL plus D0 by P0 into GS minus GL into H plus GL. This is the expression for finding out required return from H model. Now let's take an example for this. Let's say the dividend yield for a company is 30%. It has its initial rate at 15%, which declines to 8% over a period of 10 years, right? What we need to do is find out the required rate of return. Okay, so here we already know the formula, right? R is equal to D0 by P0. This is nothing but the dividend yield. D0 by P0 1 plus GL again plus T0 by P0 GS minus GL into H plus GL. This is equal to 0.3 1.08 plus 0.3 0.07. 2H was equal to 10 years, so H is equal to 5 years plus 0.08. Therefore R is equal to, quickly calculate the value guys, 0.3 into 1.08, 0.324 plus 5 into 0.07 into 0.03, 0.0105 plus 0.08. So this is equal to 0.4145. So a huge required rate of return of 41.45%. This is the answer according to our example. So a simple way to find out the sustainable growth rate is simply to multiply the retention ratio with the return on equity. Now what is the reason behind this? One simple reason is why. If we ask why this expression is holding, or it is sometimes used in a simple way, one of the reasons is larger the retention, larger is the future earnings and dividend growth rate, right? If earnings are not retained, Where will the growth come from? Right? You have to arrange external funds. And the second reason is, yes, the question is, why don't you raise external funds? Here comes the second reason. The second reason is external funds is costly. So it increases your risk, it dilutes the equity. If you raise it through equity, then it dilutes the equity. So it is much less a preferred way than retained earnings or retained profits. So this is the best way to gauge what is going to be the long-term growth rate in a sustainable manner. Here there are a couple of assumptions behind this. One is the capital structure is constant. Capital structure is more or less constant over time. Second is stock is not issued. Common stock is not issued. Here we are talking about common stock. These two situations are taken as constants for this to hold more or less true. Okay. Now the question may come, external funds, why is it costly? This cost IB charges, that is investment banking charges, coupons. If you are taking debt, you are increasing your leverage and you are paying coupons, right? If you are buying equity, then you are diluting it. If you are issuing equity, you are obviously diluting your capital structure of equity stakeholders. So these are the basic ways to understand why we use this expression as a sustainable growth rate, a simple expression for sustainable growth rate. Now we will try to delve a little deeper into this expression. Let's see. So G is equal to B into ROE, right? Now this can be written as retention ratio, means it is net income minus dividend by net income, right? Into, here this means net income by equity. Let me write DV here. This becomes, let me write it DIV, dividend, net income into let me say it is net income by assets into assets by equity. This again we can write as net income minus dividends by net income into net income by sales into sales by asset into assets by equity. So this can become our final elaborate expression for sustainable growth rate. It is the same sustainable growth rate which is expressed as B into ROE. The only thing is we have broken it up a little bit more. Present value of growth opportunities. So if we have to include this in our expression of let's say single stage Gordon growth model, Let's start with the Gordon growth model first. V0 is equal to D1 by R minus C. This is the expression, right? So this is equal to E1 into payout ratio, which is 1 minus the retention ratio, divided by R minus C, is equal to E1 by R minus G minus E1 into B by R minus G. Now let's take this expression only, this expression E1 by R minus G. This is greater than E1 by R, obviously, if G is a non-zero number, if G is greater than 0, that is it has positive growth rate. Now let's say G is equal to 0. There are no growth opportunities, there is no growth. So ideally, what do you think should be the retention ratio? If a company has no scope to grow, what should be its retention ratio? It should be ideally 0, right? It should pay out all its earnings. So this V0 should become is equal to E1 by R. Whatever extra amount, if there is a growth opportunity, apart from this no growth condition, this is the no growth condition, right? If the value has to be greater than this, it has to be the value of growth opportunities, right? So the entire expression for Gordon growth model can be translated to this. If there is no growth, the value is this, right? E1 by R. If there is some growth opportunity, and if we are using some other, this version of the expression, we are not using this R minus G in the denominator, then V0 has to be expressed in terms of E1 by R plus present value of growth opportunities. So this is one way to express the same Gordon growth model in a different way, in a little tweaked way. Again I will repeat, if growth rate is equal to 0, then ideal thing is reduce the retention rate also to 0. So the expression becomes simply V0 is equal to E1 by R. Now if growth is possible, then this becomes the expression V0 is equal to E1 by R, which is the condition of no growth, the value under condition of no growth plus whatever the present value of future growth opportunities are there. Now what determines the present value of the growth opportunities? There are two factors. One is the value of the projects which can be taken. Second is, can I scale up or scale down according to my will? Scale up or scale down according to my will, that is the promoter's will. Can the timing be adjusted? Timing control is there. These three factors, basically one factor is the value and the second is the flexibility, scaling up or scaling down and changing the timing, beginning time, ending time according to the will, right? So these two factors mainly determine the value of present value of future growth opportunities. So this was about it for the dividend discount model chapter, my friends. You can look at the options of joining the CFA 2 classes that we are conducting. You can either join the classes directly or you can join the doubt clearing sessions where all your doubts are taken care of in terms of questions, concepts, theoretical problems, mathematical problems, all these factors. In either case, you get access to the practice item sets which you can practice in addition to your CFA LES and enhance your fluency. Thank you, my friends. All the best preparing, and see you in the next chapter.
So guys, congratulations on completing this segment. Let's move on to the next segment. The video is on your screen. Hope you enjoyed this video. If this video added value to you, please like the video and subscribe to the channel. Share this with a friend who is interested in finance and investing.